I'm Christina Dutton. I'm the co-founder and network coordinator for the African Law and Technology Network. We work at the intersection of law, legislation, regulation, and technology, working with a range of actors and governments on the continent.
Hi, my name is Amaya Scarity. I'm a partner at QED Investors. We are a global fintech-only venture firm. In 2022, we made our first investments into the African continent in a couple of companies in Nigeria and Kenya. So we're excited to be here. And before this, I spent 8 years at the U.S. Treasury Department. I was a first day, last day political appointee of the Obama administration.
Hi, everyone, and thank you, Christina, and Zeke as well. Magdi Amin, I'm managing partner of African Renaissance Partners. It's a new fund focused on the Horn of Africa. We're trying to leverage and catalyze venture capital as a force to create economic opportunity in the region.
Hi, I'm Jude Ogeni. I'm the General Counsel and Chief Compliance Officer for OpenNode, which is a global Bitcoin payments infrastructure company. And before that, I was the Chief Legal Officer for Paxful, which is a peer-to-peer Bitcoin crypto exchange. Thank you.
Hi, everybody. I'm Sam Sturm. I'm co-founder of Founders Factory Africa. We are the most hands-on early-stage investor on the continent. We invest equity from idea stage through seed, alongside our venture studio, which is 45 hands-on technical and operational experts who support every venture that we invest in. We have a headquarters in Johannesburg, offices in Cape Town, Lagos, Nairobi, and London, team of 45 and a portfolio of 57 ventures across the early stage maturity curve in healthcare, fintech, and ag.
Hi, everyone. My name is Larry Ogunbe. I'm the co-founder and CEO of Identipass. Basically, what we do is we do KYC, data verification, and also ensure that identity theft is reduced in the entire market. And so we work with a lot of fintechs, those in insurance space, those in healthcare or any other asset management, to ensure that they can easily identify their customers real time, and also any business that they deal with. So we work very closely with governmental regulators to reduce identity theft, to also bring people that have never been online forever to come online, and also get identified every single time they want to transact.
Great, thank you all. So our goal today, and having our panel and this nice collection of people here, is to kind of go into best practices for both regulators and fintechs and other providers in the market, as well as kind of looking into the critical time it is for regulation and seeing how regulators can make sure they're staying up to date and meeting the demands of the market. So I think just to kind of kick it off a bit, I think we should start with looking at the environment. I think that's one element that people dive into the conversation of regulation, and we were actually just speaking about this without really contextualizing your discussion on what is possible within the jurisdiction you are operating in. As a fintech company, as a startup, whatever industry you are in, across Africa as well as the world, every jurisdiction is a little bit different and has different conditions, opportunities, constraints. So Amias actually has a lot of experience working elsewhere and is new coming into Africa. So maybe you can talk very briefly about some of the more unique restrictions you've come up against and regulatory challenges, kind of at a high level, that maybe you don't see in some of your other jurisdictions.
Yeah, I mean, I think one of the things that I would highlight is sort of a couple of things that, from the sort of large investor perspective, right? We are investing in sort of very large outcomes. That's the idea. And that implies a couple of things. So one is that almost certainly it implies multi-jurisdictional companies. And you can imagine other types of venture investors and investors who, want to build for one geography or one country. But for us, when we do the math on how big a company needs to be, it's almost by definition going to be cross geography. And that implies just a level of both seriousness and nimbleness around local regulatory compliance and what you might call like global standards. So even if you're not operating in the US at all, if you're going to be moving money cross-border, you're probably going to be touching US banking rails, because that's just the way the world works. So that's probably the first thing. And then the second thing that I would highlight, and this is maybe even more a perspective for the regulators or policymakers or those who may be interacting with them, is that our analysis starts very seriously with a rule of law question. Because ultimately, we're US investors, we need to, in the ultimate case, we need to sell a company and then extract the dollars back to our LPs. And that requires a really stable 10, 12-year view on rule of law. And so I think those are probably the two biggest differences when we think about investing on the continent. By the way, it's not just the continent, it's also Southeast Asia, it's also South Asia, it's any place you're in smaller population centers, like Eastern Europe has the exact same issues. But it's those two questions around building for multi-geo and really having to have pretty strong views on a durable rule of law framework, which I think are pretty different here than as compared to a US market or a UK or even a Brazil market where you really can just build a company for Brazil and it's big enough.
I have a follow-up question. I'm curious for you guys. So we invest, again, and we're investing, a third of our portfolio is idea stage, right?
Yeah.
And so working with them to, validate and build out first product with the same hypothesis that scale probably means multi-jurisdiction. For you guys looking at, I'm curious when you guys think about it, what is a venture that may not yet be at a multi-jurisdictional regulatory standpoint, but is thinking about that? Like, what are the things you guys see and are thinking about and are looking for at that sort of inflection point that indicate, there is a path to this is the framework and foundation for like multi-jurisdictional.
Yeah, I mean, first it's just the business model, right? So we tend to, so far at least, we've tended to be a little bit more, B2B focused. Partly, I think actually it's one of the most exciting opportunities, right? Medium-sized businesses are increasingly global businesses, right? You could have a 50-person business in Nigeria. Chances are they're going to be pretty soon going to be doing business in Cameroon or, Angola or whatever, right? Like they're going to be global. And so I think that's the first thing. The second thing is really just being attuned in the business model to the idea of building for a problem that is not unique to country X or country Y. And so that could be, how do they talk about the pain point? How do they talk about the business opportunity? So it's not that they have to prove that they're multi-jurisdictional, because we also will invest, at least small checks will consider at the seed stage, but it's more just what is the mentality of the founding team?
May I just build on that? I think being robust to multiple jurisdictions, we're talking about regulation on this panel, it also means a certain level of integrity and transparency, being mindful of KYC requirements, and not building a team or a product that really arbitrages gaps in one particular regulatory framework that would not then scale. So it's also about core principles there, and we could also talk about harmonization across regulators that might help the growth of those multi-jurisdictional companies.
I think that's that last part is like that's such a that is such a challenge that we see as ventures, hit that sort of pre-seed, seed inflection point of going to new jurisdictions is the lack of harmonization. And then even within that, if you're in a single jurisdiction, from entity to entity, the way different banks in Nigeria are working with the CBN, you're still looking at, completely different processes and sort of infrastructure, right? And so building the harmonization on the part of regulators is a point of friction. But then even internally, what we find is the lack of harmonization on the part of the financial institutions is another huge friction point and barriers for founders at an early stage.
Yeah, that point on harmonization is key. I do some work with the African Continental Free Trade AU Secretariat, and that regional harmonization is what is make or break, right? When you move through your countries, is there we talk about in tech, minimal viable product, does that exist for the regulatory context? Can we set some minimum regulatory requirements so that when someone is coming into the continent, they know that every country that's signatory will be met with that condition. And it creates a more favorable business environment, but also businesses who are starting up, they face a lot of challenges and uncertainty. Also, when they have to then sit and figure out what they actually are required to do is honestly just as complex. And I'm sure working in Founders Factory Africa, making sure you're delivering that bespoke support is really important as well. So I think another part when you think about, commonality and scaling, and we hear about leapfrogging in Africa constantly, and that does require, a solid platform to leap from, right? And like you said about rule of law, critical. But another thing is just general infrastructure that a lot of us take for granted in our day-to-day lives, and that's something that Lanre is working tirelessly on with Prembly and Identity Pass. So maybe I'll have you speak to the critical nature of digital identity and building that infrastructure on the continent.
Mm-hmm. Thanks so much for that. Now, we can spend the entire day talking about regulation and how it works, but sometimes when I look at the entire continent, I need us to understand that different countries are in different stages of this conversation, right? And so when you talk about leapfrogging, which you mentioned, not all countries can leapfrog at the same time. So if you transfer money in Nigeria right now from a bank to another bank, if you do not get that money within 2 minutes, you get a panic, because the banking system in Nigeria is so fast that you need to get the money right. If I send money right now from my Bank of America to another bank here in the US, it's fine if it doesn't get here within a day or two. That's the system. But in Nigeria, you get to contact the customer support if you do not get that money in 2 minutes. Now, if you move to the eastern side of Africa and you go to, let's say, Kenya, where M-Pesa is doing a great job from the wallet system, that's also very instant, right? But if you move down to other regions and go to like Namibia and all that, there's a different ball game, right? And so, is that from, sometimes when we look at the regulatory standpoint, we've mapped out the entire region to say which of those regions can easily, do have the level of infrastructures that would make them leapfrog. But we also need to state that there's so many regions within the continent that are not yet in the spot, they're not there, they're not yet ready to leapfrog. There's so many countries right now in the region that do not even have data laws, active data laws. Now, and with our work, what we do today is when we meet with so many government regulations, we're kind of shocked when they don't even have any law to even protect the citizens, right? But you have other countries like, Nigeria having NDPR, almost similar to GDPR, Kenya also having their own data laws. But you'll be shocked that so many countries do not have a standard data framework to guide the entire KYC or how you get customers' information, how you process the information and all that, right? And that's the big conversations that we also need to have, right? Where we need to begin to have intentional conversations with the regulators to say, hey, this is the type of data laws that you need to put in place. We need to also have conversations about the kind of technologies that they need to put. And what we do today, right now, and I was just sharing with some of the panelists, I was saying, how much we need to meet with so many government regulations almost every single day to even help them build up the necessary infrastructure right needed. If you want to open, and I'm just going to do this, if you want to open a bank account in a country like Namibia, for instance, it takes between a month to 2 months to open a bank account. If you open the same bank, if you want to open a bank account in another country within the same continent, it's almost instant, right? And so what we do today is, depending on the region, the KYC processes, how we verify people, how we authenticate people, literally is more custom made. So we go into a country, we give you a custom KYC, we go to another country, we give you into a custom KYC. But yeah, that's how, hopefully in the next future, we'll have a system where the entire continent will have a single framework to adopt.
So if I could jump in a little bit, and you know, it may seem weird what I'm about to say, given that I'm a lawyer, but I think, frankly, you know, you mentioned about, I think it was you who mentioned, you know, sort of not working, not necessarily, you know, working the gray areas in the law being an investable thesis or words to that effect. But from my perspective, as somebody who, you know, grew up on the continent and is now working to affect change in the regulatory systems, I'm not sure how you start anywhere else but there. Frankly, I view my job as forcing the issue in many ways. The reason we have such large-scale adoption of digital assets in Nigeria is because the customer base in Nigeria simply refused to take no for an answer. And so now we are in the position of having discussions with the regulatory agencies that we couldn't have had 4 or 5 years prior. And so I will tell you candidly, and again, I hope that there are no regulators in the room because we're about to speak some truths here. The question is not, for me, is this legal? Is there a law prescribing this? It is there a law? What are the consequences of violating said law? And what is the probability that anybody is going to knock on your door and say, hey, you violated such law? And, you know, and then the fourth thing would be, if it is more probable than not that they're going to knock on your door, what is the time frame within which they're going to do that? And once you know all the answers to those questions, you can perform an expected value analysis to say, okay, it's going to cost me X. But if the benefit exceeds X, then from a business perspective, it is a decision that I think most of us operating by definition in the vanguard of this space would say, let's go for it. And so again, take crypto, and I've heard people describe what is happening in Nigeria as a de jure ban or a de facto ban. I actually think it's more de facto than de jure because you know, they prescribe banks from facilitating transactions in cryptocurrency. But if you look at what the SEC is doing, the Nigerian SEC, they're coming out with all kinds of pronouncements on how you can actually have digital assets regime in Nigeria. And there's some disconnect between the CBN and the SEC on this point. But I firmly believe it's my job to force the issue. And that happens in 2 ways. The first is to say, you know, full speed ahead. We know that there is a service that we can provide, there's value that we can provide in the marketplace. We intend fully to provide said value. And the second is whether, you know, on a parallel track or as sort of, you know, a lagging kind of phenomenon, to begin to engage with the regulatory bodies and say, you know, and I hope we get the chance to talk about this in more detail, you have a rare opportunity here because Africa is leading the world in terms of at least when it comes to my section of fintech, which is digital assets, Bitcoin specifically, where Nigeria, for example, is, per capita by some accounts, #1 country in the world when it comes to Bitcoin adoption, to say this is what the people want. You really don't want to stand in their way. And now here's how all the ways in which we can work proactively and productively together for you to avoid some of the issues that have bedeviled this segment of the industry in the U.S. and in the rest of the West.
Do you, the argument then seems, and I think, I'm not a lawyer, so this is not legal advice. But I think that idea of, like, particularly at the early stage, there is a lot of gray area not to be exploited, but that simply exists and needs to be built into. On the crypto side, it seems like the argument then is almost the hope for a too big, almost the hope for a too big, like in the vacuum of regulation, a too big, almost the getting to a point of too big to fail, wherein you have this industry which is now big and, because it is desired, because it is, there's an opportunity, and the hope that, if we are big enough, regulators will need to come around. That assumes agility on the part of regulators. The risk, then, I'm curious how you guys think about this. The risk becomes kind of, what we saw with digital lenders in Kenya, right? Which was just like, we're not agile enough, we're not quick enough, we are so behind the 8 ball on this regulatory piece that we're just gonna, we're gonna shut, we're gonna shut things down, right? Now, again, you can argue in Kenya there were a lot of probably predatory lenders that ended up going out, which was a good thing, but like there was a real slowdown and a real contraction of the market because the regulators found themselves on the back foot and kind of unable to catch up meaningfully. I guess, like, how do you guys, again, it's different in crypto than it is in digital lending, I imagine, but like how do you think about that, I guess it's that risk-reward profile of getting so big that they need to do something, but are they in a position to actually meaningfully enact something that works as opposed to, is kind of prohibitive and restrictive?
Yeah. I mean, I think, I don't know if you're okay with us keep.
I apologize. We were hijacking this from
moderator had a good game plan, but we're running away with But I think as long as you're good with it, we're good too. All right. So, I think where it comes down to regulation, first principles competition. Where I stand from, where I come from, I work in markets, particularly Sudan, Ethiopia, and the Horn of Africa, where state-led solutions have left massive gaps, massive numbers of unbanked people, 93% or so in South Sudan, let's say, 80% in Sudan, 60 some odd percent Ethiopia. So the first principle is, I think good regulation means to be a bit permissive, to allow competition to happen, but to be very clear about what are the public goods at stake, what are the public interests at stake from a policy standpoint that need to be monitored. And in crypto, some of that was unclear, but it was also to a number of regulators, especially in Africa, where control over money supply is a bit weak, and you have high inflation, and you have fraud. So I think there needs to be a bit of a quid pro quo among people in the industry. Yes, I mean you're also making the sort of the Peter Thiel 0 to 1 argument. You go to places that don't exist, make it happen. Those are the best businesses. And I kind of agree, but when you're responsible for managing the safety and soundness of the financial system, and for the consumer protection and data protection, there needs to be a bit of a quid pro quo. We as investors do need to be careful to make sure we're backing founders who are willing to be transparent, who are compliant with KYC, who are not, promoting things that are obviously against the public interest like fraud, but we also need to maybe collectively start helping to build capacity of regulators who can't keep up with this. going from traditional banks to digital payments to neobanks to embedded finance to crypto within the same 2 or 3 years. No, that's not going to happen, right? So we can help, but there has to be a bit of a willingness to be open, to be transparent, and therefore be open to the kind of regulatory risk management that governments just simply need to do in exchange for that freedom to move. And it's that freedom, that permissiveness that allowed M-Pesa to happen, that allowed Kenya to take off, and allowed the unbanked problem to be solved where it's been solved. So, yeah.
So if I could respond to that, I think that's exactly right. Like, you know, personally, professionally, I wouldn't have any disagreement with that. The only thing that I'm saying is that we can get to that place if we, to some extent, force the terms of the debate, right? So I'll give you a specific example. I firmly believe that we need to have AML, KYC compliant businesses. The question is how? And what I have been saying to regulators in Africa is you cannot simply clone the system that exists in the US and in Europe. Those are different systems built with different cultures and perhaps underlying concerns and a different sort of infrastructure. So you have the opportunity to leapfrog into a bespoke system that works for you. I'll give you another specific example. Here in the US, the reason you don't have regulatory clarity, or one of the reasons, is because of this nebulous concept of an investment contract, which leads to fights between the SEC and the CFTC as to whether a given digital asset is a security or a commodity. And there's a lot of history that led to the inclusion of that term in the definition of security in the 1933 Securities Act, okay? It's almost 100 years old, but there's a lot of history that went into that. Nigeria's securities laws do not at present have the definition of the term investment contract in their securities laws. They have the typical things that you would see, stocks, bonds, et cetera, but they do not have that phrase, investment contract. Therefore, when we are thinking about a bespoke regulatory system for digital assets, we don't have to, as the US must necessarily do, try to force the concept of a digital asset into this whole investment contract construct. It has these Nigeria and other African countries have the ability to design something that is suited for ab initio for digital assets. And so when I see Nigeria's SEC purporting to put out regulations that would now incorporate the term investment contract, that's where I go to them and say, stop. You're making a mistake. There's no need for you to repeat the original sin of securities regulators from the US. You can do something different. But I only have leverage to come to the table, if you will, to have that discussion if I have that MVP out in the marketplace, people like the product, they're using it. So if we can demonstrate utility, then we can increase our bargaining position to address safety, soundness, KYC, AML, all of that stuff. But in the abstract, I'm concerned, and history would say I have every reason to be concerned, that left to their own devices, they will simply clone laws from abroad that have no business on the African continent.
Yeah, I think that's a great point. Somehow I'm already being flagged down that we're out of time, but I think we've raised a lot of interesting points around what it means to also be a proactive or reactive regulator, and that also, as you just raised, Jude, that being a proactive regulator is not the same as being a regulator who goes out and copies other people's regulations and imports it to their own system. That's not being proactive. That's a pinch hit solution. But anyway, thank you all for joining us today. I know that flew by quickly, and we got to cover some different topics than we weren't expecting, but I am 10 out of 10 always here for more of a conversation than someone throwing questions at people. So thank you all for coming in today, and thanks everyone for showing up to listen a bit.
Thank you, Christina.